With rates sitting at 6.7% and banks tightening up, more self-employed buyers are getting denied right now than I've seen in years. This client's tax return said $48,000 of qualifying income. We qualified him at $16,000 a month using a bank statement loan. Here's exactly how, step by step. I'm Connor Webb, mortgage loan originator here in Clark County, Washington. I work with a lot of business owners and contractors and 1099 earners who get told no by a bank and quietly decided homeownership just isn't in the cards for them. Today, I'm going to break down what a bank statement loan actually is, who it's for, the honest trade-offs, and exactly what you should do next if any of this sounds like your situation. This is Living in the PNW. If you want straight answers about Clark County, mortgages, real estate, and the stuff that actually moves your money, make sure to subscribe. And here's the thing that surprises most self-employed buyers. It's not the loan itself. It's how simple the path becomes once you're talking to someone who's actually built for the way you earn money. Stay with me. Quick story to set this up. A client of mine walked in a while back with a stack of denial letters. 3 different lenders, 3 rejections, all inside the same few months. Every one of them ran the exact same play. They pulled his tax return, saw about $52,000 in net income, and that was it. Nobody asked about his monthly bank deposits. Nobody asked how his business was structured. Nobody asked the question that changed everything. He closed on a $485,000 home about 45 days later, same income, same tax returns, different questions. Here's the issue. The way most banks underwrite a mortgage was designed decades ago for a W-2 employee with one steady income stream. It was not built for the contractor who writes off their truck. It was not built for the consultant who gets paid in big chunks a few times a year. And it definitely was not built for anyone whose accountant is genuinely good at their job. And at a 6.7% interest rate, with the Fed holding rates and leaning hawkish, banks are getting more conservative, not less. Which means even more people are hearing no right now who could absolutely afford a home. When you get denied, it's usually not because you can't afford the house. It's because the lender asked the wrong questions and then blamed you for their limited toolkit. Here's the different question. What does your bank account tell me that your tax return doesn't? That's the whole foundation of a bank statement loan. Instead of qualifying you on the net income from your tax return, we qualify you on the money actually flowing into your account. We look at 12 months of bank statements, we see what your real business is doing, and we use that as the income number. Back to the $48,000 client. His tax return showed $48,000 after his accountant correctly applied every legal deduction. But his bank statement showed about $14,000 a month coming in every single month like clockwork. That's roughly $168,000 a year flowing through his business. His real ability to pay a mortgage was about 3 times what his tax return suggested. 3 lenders looked at the tax return, said no, and moved on. I started with the bank deposit. Different question, different answer, different loan. Now here's why this matters more right now than it did 6 months ago. At a 6.7% interest rate, the bar at traditional banks is higher. Underwriting standards get tighter when rates climb because higher payments means tighter debt to income ratios, which means more automatic no's from the same systems that were already too rigid for self-employed borrowers. So if you got denied at 5.99% back in February, the same bank is even less likely to say yes at 6.7%. The need for a lender who uses a different toolkit is literally growing every month. Quick pause. If you're sitting there going, that's me, that's literally my situation, I want you to know that there's a link in the description to set up a no pressure clarity call with me and my team. We'll look at your actual numbers and tell you honestly where you stand. No commitments, just clarity. Now back to it. Now I'm not going to oversell this because the second I do, your brain is going to say this sounds too good to be true. And you'd be a bit right to think that. So here's the honest part. A bank statement loan typically has a rate that's a bit higher than a conventional loan. At 6.7% on a conventional loan, a bank statement rate is going to be higher than that. Realistically, currently only in the low 7s. That's a small trade-off. For a lot of self-employed buyers, it's absolutely worth it because the alternative is no home at all, which means more rent paid, more appreciation missed, and no equity being built. And once your tax return catches up to your real income or your situation changes, you refinance into a conventional rate. You marry the house, you date the rate. Sound familiar? Same principle as the climbing interest rate environment, just applied to your specific loan. The other thing I'll be straight about, not everyone qualifies. If your deposits are inconsistent, or if your business is brand new, if there are credit issues that haven't been addressed yet, those are real conversations. Most of them are flexible. Some take a little time, but pretending otherwise would be exactly the kind of pitch I'm telling you to be careful of. Let me make this concrete. If any of this sounds like you, this is a conversation you should be having. You're a small business owner whose tax return looks small because your accountant is doing their job. You're a contractor with strong, consistent deposits. You're a creator or influencer getting paid by platforms and your income is real, but it doesn't fit the shape banks like. You're a real estate investor whose rental income gets buried in Schedule E. You've been told no more than once and you're tired of explaining yourself. Different people, same toolkit. The point isn't that there's one magical loan. The point is that there's a lender who knows which loan to point at your specific situation. And one sidebar worth knowing about, especially in this rate environment. Some current sellers have assumable mortgages, meaning you can take over their existing loan at the rate they locked years ago. At 6.7%, that gap between a 2021 rate and today's rate is the widest it's been in a while. It's not for everyone and there are real catches, but it's a real tool. I've got a full breakdown of how assumable mortgages work in another video. Link is below. So if your real income doesn't match your tax returns, stop letting one denial or three define what's possible for you. The link in the description sets up a no pressure clarity call with me and my team. We'll look at your actual numbers and tell you honestly whether there is a path. Worst case, you finally know where you stand. If this was helpful, make sure to subscribe, and if you want to help more people in our community see this, make sure to hit that hype button in the first 7 days. It makes a real difference. Thank you for watching, and we'll see you in the next one.